Picture this. You finish a backtest and the report looks almost perfect. The balance curve climbs smoothly. The profit factor is strong. Drawdown looks manageable. For a moment, it feels as if you have finally found the answer. Then you move the same strategy into a demo or live account, and the experience changes. Entries arrive later. Costs are higher. Losing periods last longer. The beautiful curve starts to bend. So was the backtest fake? Not necessarily. More often, the test answered a narrower question than the trader believed it did. In this video, we will look at 5 reasons a great backtest can disappoint in live trading, and then build a practical checklist for testing an expert advisor more honestly. The first idea is simple, but it changes everything. A backtest is not the market. It is a model of the market. It combines historical prices, trading rules, costs, execution assumptions, and your selected parameters. Change one of those ingredients, and the result can change too. That does not make testing useless. It makes testing conditional. A report is evidence for how the strategy behaved under a specific set of assumptions. It is not a certificate saying the same curve must appear again. This is why a smooth curve can be so persuasive. Our eyes reward consistency. We see a clean upward line and immediately translate it into words such as stable, reliable, or safe. But the graph does not show how many alternatives were rejected before this one was selected. It does not show whether a small parameter change destroys the result. And it does not show which assumptions were generous. Before asking how much the strategy made, ask a better question. How easy was it to make this report look good? Problem number 1 is overfitting. Imagine testing dozens of entry filters, several stop distances, multiple take-profit levels, different sessions, and many indicator periods. Even if no combination has a real edge, one result may look exceptional by chance. The more combinations you try, the easier it becomes to discover yesterday's lucky pattern. That pattern can fit the historical sample very closely and still have little value when new data arrives. Optimization is not automatically bad. The danger is treating the single best pass as proof. A useful response is to stop worshipping the peak. Look at the area around it. If one exact setting performs brilliantly, while nearby values collapse, the result is fragile. A more believable strategy often has a plateau. Several neighboring settings behave reasonably well, even if none of them produces the highest headline profit. In other words, prefer a broad hill to a single needle. You are not trying to predict the perfect number. You are checking whether the underlying idea survives small changes. The next defense is separation. Use one part of history to develop the logic, and a different part to evaluate it. MetaTrader 5 also provides a forward period during optimization, which reruns selected results on a later section of data. The important point is independence. If you keep changing the strategy after seeing the validation result, that validation set has quietly become development data too. You can still learn from it, but you should no longer call it unseen evidence. Problem number 2 is weak price modeling. This matters especially for scalping, tight stops, pending orders, or any logic that reacts inside a candle. A 1-minute bar contains an open, high, low, and close, but those 4 points do not fully describe every tick or the exact order of movement. A rough modeling mode may be useful for a fast first check. But if the strategy depends on what happened inside the bar, the final test needs more detailed price data. MQL5 documentation makes the distinction clear. Open prices only and 1-minute OHLC modes can be much faster, but they simplify the path of price. Every tick testing is more detailed, and every tick based on real ticks can better reflect the broker's recorded tick history. The right choice depends on the strategy. A system that only acts on a completed hourly candle may be less sensitive. A 5-minute scalper may be extremely sensitive. Speed is useful during development. Realism matters before deployment. Problem number 3 is hidden cost. A small edge can disappear after spread, commission, swap, and slippage. This is easy to underestimate because each cost looks small on a single trade. Multiply it across hundreds of entries, and it becomes part of the strategy. Pay special attention when the average winning trade is only slightly larger than the average cost. Also check the time of day. Spreads around rollover, thin liquidity, or major news can be very different from a calm session average. A backtest that assumes friendly costs is not conservative. It is simply testing a different business model. Now we reach problem number 4, perfect execution. In a simple test, an order can appear to move from decision to fill with no meaningful delay. Live trading has a chain. The expert advisor detects a condition. The terminal sends a request. The broker processes it. Price may move before the order is filled. Stops may face minimum distance rules. A request can be rejected, requoted, or filled at a different price. MetaTrader 5 can simulate execution delay, and this is worth using when the strategy is sensitive to a few points. Broker differences create another layer. Two brokers can use different price feeds, spreads, server times, contract specifications, stop levels, and symbols. Those differences may barely affect a slow strategy, yet materially change a short-term system. This is why a test from one environment should not be presented as a universal result. If possible, repeat the test with another credible data source or broker. You are not looking for identical profit. You are looking for the same basic behavior. Problem number 5 is market regime dependence. A trend-following system can look brilliant during a long directional period. A mean reversion system can shine in a stable range. Neither result proves the logic can handle the opposite environment. Break the history into meaningful periods. Look at strong trends, quiet ranges, volatility shocks, and transitions. Then inspect yearly and monthly results rather than only the final total. A strategy does not need to win in every regime, but you should know where it is vulnerable. Out-of-sample testing is valuable because it asks what happened after the design choices were already made. A walk-forward process repeats that idea through time. Develop on one window, validate on the next, move forward, and repeat. It is not magic, and it can also be abused with too many choices. Still, it is more informative than optimizing the whole history and celebrating the same history. The goal is not to remove uncertainty. The goal is to see how the strategy behaves when it loses the advantage of hindsight. Sample size matters too. 10 or 20 trades can tell a story, but the story may mostly be luck. A larger sample is not automatically reliable, because thousands of very similar trades can still come from one market condition. Count trades, then read them. Are profits spread across months and years? Are they concentrated in one short period? Does one unusually large winner create most of the result? If removing a handful of trades changes the conclusion, the edge may be thinner than the headline suggests. The same caution applies to drawdown. Historical maximum drawdown is the worst sequence that happened in that sample. It is not a ceiling. Live losses can arrive in a different order, costs can be higher, and the market can create a regime that history did not contain. This is why position size should be chosen from tolerance, not excitement. If the historical drawdown already feels emotionally or financially unbearable, increasing the lot size will not make the strategy easier to follow. So what does a more honest process look like? Start with a clear hypothesis. Separate development and validation data. Use a modeling mode appropriate for the strategy, then include realistic spread, commissions, swap, and delay. Check nearby parameters instead of only the winner. Inspect results by year, month, session, and market regime. Repeat the test in another environment when possible. Finally, run a small forward test before increasing risk. None of these steps guarantees profit. Together, they make it harder for a weak idea to hide behind a beautiful report. Think of deployment as a ladder, not a switch. First, confirm the logic in a backtest. Next, stress it with worse costs, delay, and modest parameter changes. Then observe it on a demo account. If the behavior remains understandable, move to a small live risk that you can genuinely afford to lose. Only consider scaling after live evidence accumulates. Each step answers a different question. Skipping steps does not create confidence. It simply moves uncertainty into a more expensive environment. Here is the main lesson. The best backtest is not the one with the highest profit. It is the one whose assumptions you can explain, whose weaknesses you can see, and whose behavior remains reasonable when conditions become less friendly. A backtest should challenge your idea, not protect it. When the test is designed to find failure, surviving results become more meaningful. You still will not know the future, but you will understand what evidence you actually have. If this was useful, subscribe to Atsushi K. Forex Lab for more videos about MT5 tools, expert advisor development, backtesting, risk, and practical Forex research. Trading involves risk, and this video is for educational purposes only. Thank you for watching.